You're watching TwoMinFinance. Tonight, why Intel is getting re-rated on Wall Street, and why President Trump is publicly celebrating the stock on Truth Social. Educational market news only, not investment advice. Intel has become one of the most dramatic stories in U.S. equities in 2026. Shares have roughly tripled year to date, a move that would have sounded impossible when the stock traded near $20. The market is no longer pricing Intel only as a struggling legacy chipmaker. It is pricing a potential foundry comeback, government backing, and marquee customer wins. President Trump has made Intel a public priority. On Truth Social he credited his administration with more than $30 billion in paper gains on the government's Intel position in roughly 90 days. He praised CEO Lip-Bu Tan after meetings in Washington and highlighted Apple's agreement to work with Intel on U.S. chip design and manufacturing. Whether you view that as industrial policy or politics, it is clearly moving the narrative, and the multiple investors are willing to pay. The Apple headline is the core re-rating engine. Bulls argue winning even a slice of Apple's advanced packaging and U.S. manufacturing could transform Intel Foundry from a loss-making internal unit into a real external business. Skeptics counter that ramping the 18-angstrom node is expensive, yields still need to prove out, and Apple's volumes are unforgiving. The stock's wild swing from the low 20s toward triple-digit levels shows the market is betting the bull case, not that it is proven yet. Washington is not just cheering from the sidelines, it is on the cap table. The U.S. government took a 10% stake in Intel, funded partly through CHIPS Act grants and awards. On paper that position has swollen to more than $46 billion as the stock rallied. That creates an unusual dynamic, policy support, public cheerleading, and a taxpayer-linked mark-to-market gain that the White House is eager to advertise. Here is the re-rating tension. Roughly 31 of 44 analysts still have a hold on Intel. They are not fully buying the transformation at today's price. The average price target near $79 implies meaningful downside from recent levels near $108. Even the high target near $118 leaves limited upside if you believe the most bullish analyst. Yet the stock keeps climbing because momentum, policy, and headline risk are overpowering traditional valuation models. That is classic re-rating behavior, the story changes faster than the spreadsheet. For the re-rating to stick, Intel still has to execute. Management says 18A yields are tracking ahead of internal targets, but foundry ramp is pressuring margins. Second quarter gross margin guidance near 39% is slightly below the first quarter. Rising input costs for memory and substrates are a headwind. Partnerships with Apple, Nvidia, SpaceX, and XAI on Terafab sound great on slides. Investors need revenue, yields, and cash flow to confirm this is not just a policy trade. Recap: Intel's 2026 surge is a re-rating driven by foundry hope, Apple's U.S. manufacturing headline, and Trump's public push, while most analysts remain cautious on valuation. Subscribe to TwoMinFinance for daily U.S. market news. This is education only, not a recommendation to buy or sell Intel or any other stock.